We have with us market expert Sunil Subramaniam joining us to decode what lies ahead. Sunil sir, good afternoon. So good to have you back. But markets clearly at tenterhooks. So how are you reading the sentiment for India? Because we have the global markets which are already at record highs, hoping for a peace deal could be on the horizon. But we are still subdued despite the cool off that we are seeing in the crude oil. So yes, your first thoughts.
Yes, but I think the cool off is only relative, right? At
Yeah.
92, $93, it still hurts India. I don't think India is out of the woods from an impact of crude at the mid 90s levels. We need to get it below 80, which looks difficult. So I think the first thing is that we also, I think, have to wait for the RBI policy, which is a big question mark today because can RBI ignore inflation, which is high? Though it's supply side, technically supply side inflation is on not a monetary policy thing, it's more of a fiscal side that you got to address the issue. But RBI cannot ignore it. So the market is, I think, very apprehensive about how the RBI's tone is going to be. The second is though the GDP data is due this week, it's still past GDP data. But the RBI will put out its own GDP quarter by quarter estimates and inflation quarter by quarter estimates for the rest of the financial year. I think those are going to be key in terms of, because I think RBI is generally reliable on data in terms of the market places a lot of value to that. So I would say the RBI policy this time is relatively more important and people wouldn't want to take positions before that. And part of the reason for the banking sector being under pressure today, I would attribute to that situation. The other thing is, of course, is that while you're mentioning that geopolitical easing, I'm not sure that it's really an easing because Iran still, is not accepting it. Israel continues to advance further into Lebanon. And there is a hidden fear that Trump is just buying time because by these talks, and he's actually replenishing his ammunitions and army, and he won't rest until he achieves his goal of securing the nuclear related assets of Iran. So if this is all just a ploy to keep the hang in play while America gets its act in order, then it's very worrisome. We don't know that for sure, but just that the fact that multiple proposals have been come at the ground level between the team, right? Either they have been talking in Pakistan or they're talking in Oman, Qatar, that area. But the fact is that Mr. Trump's not signed off on it, and Iran also keeps saying that the ceasefire has been violated, and so things are back to square one. So I think that the geopolitically, I wouldn't still call it an ease. Yes, compared to 125, 126 Brent crude, you are at 92. Yes, it's a $30 ease. But for India, it's still a 25 to $30 more than what it was pre-war. So I'm not sure that geopolitical hangover for India is over. It's still there. And for FIIs, right, of course, even they will look at the RBI policy to see whether, as a nation, we are going to address this issue. So for the government, it's been passing on small increases in petrol, in LPG, in gases, and all of that. But really speaking, the burden today still lies on the government of India's fiscal situation. So foreigners would like to see whether that is going to get addressed or is there going to be a slippage in fiscal deficit this year. I don't think the government has come out with a clear-cut policy yet on how they're going to handle this spike. It's. I think that there's a feeling that they're just hoping that the war would end and that this thing would go back to normal, which is not something the FIs are comfortable. So you've seen consistent selling. Yes, the pace of selling has come down from the March month of war, which was more than a lakh crores, to about 50, 60,000 crores in the next 2 months. Yes, it's half of that month's selling, but it's still selling. And your markets are not going to get a leg up without some kind of a support from FIS, at least to start with, to bring down the selling pressure. So I think those flows are important. And we are looking at the earnings season and saying it was better than estimate. And the real reason for that is one is market itself had toned down its expectations. And second is that you had the raw materials accumulated before February, in the month of January and February, which were used in March. So I'm not sure that those quarter four earnings are any reflection of the impact of the war. It's your Q1 earnings season starting from July 10th, which will show you the real impact of all the crude and gas price increases on various sectors. So domestic investors are flush with money, whether it's retail, HNI, mutual funds, insurance, and they are continuing to support and buy. I think this month also against what, a 50, 55,000 crores this month money made. of Sapphire selling, they bought more than 80,000 crores. So they are supporting the market. So you can say that the market may not correct deeply, right? It's going to consolidate because for DIIs and for retail and HNI investors, sharp corrections in any price are a value buy and they go and pick. IT, for example, is going through that phase now. The year-to-date correction of more than 20%. So any slightly good news, something the Nasdaq goes up, it's a reason to go and do a value buying. But the point I'm trying to stress is that domestic liquidity support will continue to be strong to support, but they'll wait for corrections before they step in and buy. So domestic liquidity is not going to take the larger cap part of the market up. Yes, in the mid cap, small cap, and micro cap, where FIs don't have a big part to play, you will find that selective domestic buying can take it. And the mid cap index also recently touched its lifetime highs. So the broader market presents a different picture from the larger cap space of the market. And so for that part of it to really go up, your Nifty Sensex or your Nifty 100 or your 150, top 150 stocks, we need strong FII participation, which I'm afraid is not going to happen in a hurry. That's the reality we have to live with. There will be sector rotation happening because BIS to buy are also needing to book profits in sectors. So, for example, publisher banks are somebody who's suffering from that because they've been among the best performers in the market. At any time of time, profit booking, even today, I think it's happened. Publisher banks tends to be a soft target for profit booking. So sector rotation is again a key theme which is going to persist through this period. So real clarity, step one, RBI policy. Step two, July earnings season. Step three, war. Hopefully, by the earnings season starts, if we see a clear end to the war, which I'm giving it another month to sort itself out. Without all of these happening, you're not likely to get a strong bullish undertone to the market. But like I said, I believe that domestic investors.
Okay. I think there's a bit of a technical snag over there, so we'll just try to reconnect him. But of course, like Sunil sir was pointing out, of course, there are three main key variables for the markets to determine its direction. First is, of course, the RBI policy meeting, which is due this week, and of course, what is going to be in terms of the commentary, something that we'll be watching out for as well. And of course, the resilience in the broader end of the markets. Of course, from the past 2 days, we are seeing a bit of a profit booking, but still, the broader end of the markets have been faring well than how the large caps have been behaving in the past two trading sessions. But yes, apart from that, we'll also be watching out for India's GDP growth data, which is due on June 5th itself. And we'll watch out whether or not, the 7.8% that we saw in the quarter three is going to get sustainable. And of course, if there is what kind of cuts we are going to see in terms of growth forecast for India itself. But yes, today the markets have been fairly choppy. If you look at both the headline indices have seen about more than 0.5% cut. The market breadth has severely worsened with about NSE advanced decline ratio at about 1:2, and WIX has severely has inched up as well. And the pocket which has emerged as an outperformer, that's your IT stocks. Nifty IT index up for the second consecutive day. It's showcasing gain of about 2.5% as well. Apart from that, you have Nifty Metals also, which did quite well with about 0.5% gains coming in for there. And Sunil sir and of course Ajit was also talking about that the bank Nifty needs to do the heavy lifting for Nifty to make a further up move going ahead. So yes, the bank Nifty has seeing a bit of a decline in today's trading session. Both the private lenders and even the PSU banking stocks have taken a hit today. If you look at the bank Nifty index, it's down by about 1%, and some of the losers in the bank Nifty, we can see the likes of HDFC Bank, that's showcasing a decline of about 0.2%. ICICI Bank also with about 1% decline. SBI, Bajaj Finance, all of these financial stocks have taken a hit in today's trading session as well. But apart from that, you had the auto index also not doing well, despite what we saw a fairly good sales momentum for the month of May. Nifty Auto Index also showcasing a decline of about 1.5%. But yes, in terms of May sales, we've seen that Tata Motors PV sales had risen to about 42% on a year-on-year basis. Even Maruti has also recorded good sales numbers for the month of May. M&M with about good sales numbers of about 11% growth. Bajaj Auto with about 20% growth. So yes, largely it's been a good sales performance when it comes to all of these auto companies for the month of May. But still, some bit of sideways action we have seen given the kind of broad-based sell-off that we have observed in a market like this. So yes, that's your Nifty Auto Index not behaving as per what the numbers have indicated for the month of May. Apart from that, you can see Nifty FMCG index has definitely cooled off. This particular index is showcasing a decline of about 2% as well. But yes, coming back to Sunil sir, of course, Sunil sir, you were talking about the June policy meeting. What are your expectations? Of course, the consensus this time has been hold. But do you see a room of rate increase for FY27?
No, I think it's early. It may be only the next policy. I think this policy, they will still look beyond the war. So I think that I don't think that they will recognize the risks, okay, and they'll say we'll keep a watch. So I think there'll be a cautious tone to the RBI, but I don't think that they're ready to hurt growth through a rate hike, right? So the only reasons for a rate hike are one, if they are comfortable that growth will not get hurt by a rate hike, that's number one, which partly may be there because credit growth is doing well, number one. Number two is from a currency management point of view, right? A few days before, it was a thing that a rate hike could help get flows in, right? Because when you hike rates, your attractive rates will get you money. But I think the way the RBI has controlled the rupee over the last few days, I think there's confidence that now the rupee at the 95 level is fairly stable. So I think that fear of that as a trigger for a rate hike, I think is not there right now. The monsoon also is going to be underway. The RBI will not want to jump the gun and they'll wait for the spatial dispersion of the monsoon. So I think they'll just keep things on hold and push it forward to the next policy. But the only issue is, I think there's a language of the RBI governor is as important as the decision of the RBI Monetary Policy Committee. So I think a lot of questions will be around that in terms of the press conference. So I think that will determine the direction. I do not expect a rate hike. It's a pretty harsh move at this stage in time. But I know that there's a 10 to 15% of the market is expecting a rate hike. Bulk of them are still staying on a hold.
Got it. Sunil sir, you were earlier talking about the resilience that we are seeing in the broader end of the markets compared to the large caps. Given the kind of earnings we've seen in the March quarter, it's been spectacular for the broad end of the markets. But going ahead with the kind of inflation and macro risks that we are seeing, do you think that the rally could run ahead of the fundamentals?
Rally running ahead of the fundamentals, definitely from June, the first quarter results, right? They are going to be definitely below on a quarter-on-quarter basis compared to Q4, undoubtedly. But at the same time, and I was trying to look at what the market is trying to guess or consensus estimate for 1 year forward PE, I'll just give you a sense. The market has already been a bit conservative. So I think that if I remember right, the mid cap had showed about 30% earnings growth. The small cap had shown about 36%, and then the micro caps had shown about 42% earnings growth for the quarter. But when you look at the projection for the full year, it's only around 18, 20, and about 24, I think, for the same. So against a 30% earnings growth for the quarter four, for the year, they're only expecting an 18%. So I think to some extent, the market is trying to bake in a bad Q1, a reasonably bad Q2, and then a recovery from Q3 and Q4. With that in mind, a lot of the buying that happens in the mid and small cap is forward looking, because especially domestic fund managers are not buying quarterly earnings. They are buying what they see as a 3-year outlook on their EPS growth and discounting it, right, from a DCF technique. So I think to that extent, if they're still comfortable with a very strong double digit between 18 to 24% for the broader in the market for the year, then, and that sustains for FY28, I don't see any reason why buying would fall off. But if you're going to then take the trailing PE and compute the valuations, yes, you will say that the price is running ahead of the earnings. But I think one shouldn't just look at it. One has to look at it as a forward-looking picture. And perhaps if you could use a PE growth kind of a ratio instead of a PE ratio, it'll make things a little more reasonable. So I would still say that optically, yes, we could be in a situation where the price is running ahead of the earnings. But I'm not sure that that's an indication of overvaluation as much as an expectation of a decent future growth, which I think even with the war and all that concern, I don't doubt that the domestic economy, I think it can sustain a 6.5% GDP growth rate for the next 2 years. So It's not that worrisome for me. But like I said, when you look at the optics, it will probably look overvalued at the broader end of the market.
Okay, okay. But markets, they've largely focused on crude oil. Do you think monsoon could be the next trigger for a weaker consumption for the markets that is yet to get priced in?
Well, see, the problem with the monsoon predictions is that they keep undergoing changes, number one. And number two, I'm less of a believer in the actual quantum of the monsoon versus the spatial distribution of the monsoon. I don't mind if Bombay, Delhi, Chennai, Bangalore get far less monsoon, but as long as the agricultural sowing areas get good monsoon. So simply looking at an overall number and saying, oh, it's 90% of long-term average doesn't mean anything. You have to see that it doesn't in the agricultural farmlands where the sowing is to take place. Is the monsoon coming at the right time? So second is the timing of the monsoon. So despite a below average projection for the monsoon because of El Nino, if there is adequate rainfall in the correct areas, right? It should still sail through. So I won't jump the gun and expect RBI also not to jump the gun as far as the monsoon is concerned. Yes, the market is apprehensive today, undoubtedly. And if you see corrections in the FMCG space and all of that are naturally due to a weak monsoon expectation hurting demand there, undoubtedly about that. But I am still remain a reasonably optimistic person that even at a 90% monsoon, as long as it's spatially well distributed and timing wise, it falls at the right time, we could still, come through the year with a decent food grain production without too much impact on prices. The crude part of it will, of course, affect prices. That is, remember, fertilizer prices are linked to gas prices, which have been rising. So that part of it will be there. But otherwise, I don't see that the food grain production necessarily at this point in time, you need to be very bearish about it and say that, oh, the whole rural consumption story is gone. Let's wait a bit for that.
Okay, got it. So, sir, let's talk more sector specific. We've seen that IT stocks is doing once again well in today's trading session as well. It bucked the overall the subdued market sentiment, and we've seen that the AI disruption fears have led to one of the sharpest derating that the sector has seen in years. Do you think the sentiment has turned excessively negative, and from here on, any positive news will be taken well? But is it too early to read into the short-term bounces that we are seeing in the sector?
I agree with the first part of your answer that yes, there has been excessive derating of the IT sector. For example, I was looking at the calculations that people are doing for various companies and the sectors. And what's happening is the current valuations are indicating that is as if in 5 years' time, the IT business will not exist. So I don't think that's going to be the case, right? If you already dig deeper, I would rate that the IT companies are actually working very hard on AI. There have been indications that most of the customers of the IT companies are willing to give them a chance to use AI and help them in the AI re-engineering of their businesses. I'm talking about the user businesses. So it's not like IT companies have been straightaway said, oh, you're useless for AI, right? Where the problem has been is on their public relations part, on the way they have handled the analyst on calls, especially of FIIs, in terms of their AI readiness, right? So that's one. Second is that this negative image of AI hurting IT was overdone for the example that AI is going to transform a huge list of user industries, whether it's consumption, banking, manufacturing, retail, everywhere AI is going to be doing. But somebody has to guide those companies in the adopting the right AI model, doing it. The threat that AI will displace an IT company and a user company will just take AI and use it is far-fetched. I think the answer lies somewhere in the middle. Yes, definitely the models that the IT companies have so far been thriving and succeeding on as a per hour or per employee has to undergo significant change. But I believe that these companies can do it. So the doomsday scenario, which has been currently been plugged into their valuations, I believe is overdone. Right? That's agreed. But at the same time, I don't agree with the second half of your thing that this is the boom bust kind of a scenario. I believe that what has happened to IT is this shifted from a growth sector post-COVID, which it adopted. Everybody thought that in the Internet of Things, a new scheme of things, post-COVID, work from home, everything digitized, that IT would be like super growth. That dream has been kind of killed, and it's now more of a dividend yield, value, sustainable businesses for long term, available at reasonable valuation story. So when that readjustment process, I'm not sure it still happened. A lot of people still have IT as a growth part of their portfolio. They will have to shift it to value. And depending on what allocation they think it deserves as growth versus value, value will definitely get a smaller allocation. But there could be a new set of buyers like pension funds and all those people who want a regular dividend yield, good companies, which IT fill that for it. So there is a balance there. So for me, IT is first for any investor, look at it as your value pick and allocate that right amount there. Now, if you think that you've had too much to it, you may need to correct it, fine. But if you're not, maybe you can add. So that's one. Second is that the IT is also very ripe for a technical, not technical, but a tactical short-term outlook investor. I mean, it's a very complicated word that I'm using. Why I'm saying this is definitely because it's overcorrected, you will find these bounces and people can step in and step out and make money. You need to be smart. You need to have your book profit and your stop losses very clearly done. But I see a lot of players are entering IT in that manner, and they will provide their own buying and selling support as IT goes through its cycles. And finally, I will say is that the currency plays a very important part here because while the rupee has recently strengthened thanks to RBI buying, if oil sustains at 92, I don't think that you can expect the rupee to remain at its 95 levels. I think we have to be prepared for late 90s, even 100 rupee dollar in about a year's time. And if that happens, definitely IT companies in rupee EPS are going to get at least a 2, 3, 4% EPS tailwind because of the currency. So that's another reason to tactically stay invested or buy into IT. So there's a whole lot of things that I've said. There are pluses and minuses. So just to summarize, I believe that the correction is overdone, but I still don't believe that IT is a growth sector on which you can bet on, saying that it's going to continue to increase in valuations and earnings. That's not the case. Answer lies somewhere in the middle. Either you're a very tactical player who looks at currency depreciation, looks at valuation, looks at that and steps in and steps back out, or you are a long-term value investor who's interested in getting a decent dividend yield with not too much volatility going forward in that sector, then that's your play.
Okay, got it, got it. What about banks? So, because we have seen a modest earnings, and it used to be a consensus buy amongst all the brokerages. But right now in the fourth quarter, it's still seen the earnings have turned out below what the street was expecting. What can FY27 tell us when it comes to the banking sector?
Well, I think that the key factor there is the health of the banking sector is in good shape, number one, from an NPA perspective. Second aspect is that I expect that the credit growth has been running 3 to 4 percentage points above the deposit growth. So that's been generally perceived as a negative to the banks because cost of borrowing, cost of deposits will go up, then the net interest margins could get squeezed. But I have a slightly contrarian view there. I believe that the credit growth is going to go even faster because one of the factors of this oil price rising and the crude related input cost rising is that working capital funding needs of the entire corporate sector is going to go up purely because of a higher raw material cost involved, right? Some of it will go. So the working capital financing has to be done from the banking system. That's not something that a gold loan financing or a private sector NBFC can do. So banking system will get a higher credit growth continuing. And when corporates have to borrow, right? I think then they become less sensitive to interest rates. So banks should be able to pass on the interest rate hikes. So effectively, whether RBI does the rate hike or not, in the economy, a rate hike is going to happen, right? So that I view as generally as a positive, especially from a public sector bank or a private sector bank, which has a good corporate book in it, right? So to me, and especially with the credit cycle in terms of the capex cycle, if I see that as a picking up story, then I would still back the banking system to be the primary financiers to SMEs and MSMEs, where there's less resistance to interest rates, right? From a perspective of competition. It's only the AAA end of the curve that there'll be a big maramari to cut down interest rates or whatever and a fight. So I still remain healthily optimistic as far as the banking. And I think that this latest, even today's correction or recent pressures have been more due to the RBI policy uncertainty. Once the RBI policy is behind us, and I see that the consumption story will stay, which means private sector banks and NBFCs will get good EMI-based lending growth happening also. I remain bullish on the banking space, and I view that we have to keep accumulating and on dips right through this period. I'm not somebody who's going to be running afraid of banks just because the RBI policy may turn out to be bad or more not what the market expected. So I remain reasonably what do you call say you can say bullish on the medium term outlook for the banking sector.
Hmm. Okay, got it. All right, Sunil sir, with that, we have to let you go. But thank you so much for connecting with us and, of course, appreciate your time.
Thank you.